Hi, I'm Scott Robinson, Director of the REIT Center at NYU's SPS Schack Institute of Real Estate. I am fortunate to be co-hosting the 7-part REIT leadership series with my friend and industry colleague, Robin Panovka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute of Real Estate, notably as conference co-chairs of our annual REIT symposium held every spring in New York City. For more than 50 years, the Schack Institute has been at the forefront of real estate education, guiding over 700 matriculated students annually through numerous non-credit and degree programs, including a Bachelor of Science in Real Estate, MS Real Estate, MS Development, and MS Construction Management. This REIT Leadership Series was designed to bring our students and numerous stakeholders into a direct conversation with some of the folks shaping our industry today, including Jay Brown of Crown Castle International, Tom Bartlett of American Tower, Aaron Block of Metaprop, Eric Bolton, Mid-America Apartment Communities, Stuart Tanz, Retail Opportunity Investments, Tammy Jones, Basis Investment Group, and Mike Landy, former CEO of Monmouth Real Estate Investment Corp. Importantly, I want to thank the many NYU Schack students who participated in this series and leaned in to prepare accompanying research around the conversations, including Ivan Chen, Emma Denhausen-Braun, Sam Penny, Jacob Bernstein, Ross Hewitt, and Cameron Spiller. Thank you. The topics of conversation among the CEOs in this leadership series are generally focused on each individual company's strategy, but I hope you'll see that they can also be categorized into major themes such as digital infrastructure, leadership, M&A, and specific industry trends. I hope you find these conversations and the related research memos informative, and I look forward to exploring these topics with you further on social media in the coming months.
All right, we are thrilled to have with us today as part of the NYU Distinguished Speaker Series, Tammy Jones, the co-founder and CEO of Basis Investment Group. Tammy has an incredibly broad set of experiences, including working at prior companies before she founded Basis, serving on a number of public REIT boards, and many others. So we're looking forward to exploring all of those. Tammy, perhaps we could start with your overall view of where we are in the real estate cycle right now, and perhaps compare that to when you founded Basis in 2009, I believe, and how things have gone since then.
Great. Well, first of all, thank you for having me. It's a thrill always to reconnect with students and academia, because I believe so firmly that without you guys, we won't be able to deal with some of the challenges in the future. And some of these challenges are rearing their ugly head right now as we speak. When someone says, how do you think it compares? Well, I think we are in unprecedented times. And I probably said that back in the GFC. I'm sure we all did. I mean, let's think about it. We have supply chain issues. We have inflation at 40-year highs. We have a pandemic. We have war. We have interest rates going up, and a host of other things that we haven't quite seen at this level of magnitude, all of these things happening at the same time. In the great financial crisis, we obviously had a leverage problem. Today, we don't really have that. We have a long in the tooth recovery for as long as any of us can remember. And so the dynamics and the fundamentals are different. The commonality is that it's a time for caution. It's a time for us to really think about the broader dynamics, what is contributing to supply and demand, thinking about migration differently. Where are people moving and living as a result of the pandemic, as a result of interest rates going up and costs going up? And so I do think that the lessons that we can learn from the GFC are that we need to make sure that we're investing wisely and that we're understanding what property types are resilient in any cycle, right? And so, and resilient property types today are multifamily and industrial, and resilient property types back then were also multifamily. If you guys remember in the GFC, when the capital market shut down, which again, I'm sure I said, if you take me 10 years ago, plus, I would have said we're in unprecedented times, but the agencies that, Freddie and Fannie provided liquidity into the multifamily market, which is a foundation for us. And that property type was resilient then, and it continued to be resilient in the pandemic.
So obviously very confusing time, as you point out, and a time for caution. Isn't the problem, though, everybody is crowding into multifamily and industrial? And if so, how are you finding opportunities?
So it's a great question. And I believe that when people say multifamily, they just have this huge bucket of multifamily. Well, I'm here to tell you that how you find opportunities is to break down multifamily into its finer subcategories. There's single family rental, there's manufactured housing, there's independent living, there's class B multifamily, there's luxury, there's affordable, there's workforce housing. And so that's how you find the opportunity, is to be diversified across some of those subsectors, to be able to find out again, think about independent living and assisted living. We have basically, I think we've entered the time, and I may get this statistic so that students can check me on this, not quite right, but there are 10,000 people turning 65 every day for the next 10 years. Think about that. The baby boomers are aging. So that's a demographic data point that anyone who's in the market and is going to be a real estate professional in the next 10 years should be watching what is happening. So that is where, real estate is, I love real estate because it's an art, not a science, and it's the fundamentals of supply and demand, and also common sense. So we're looking for where the opportunities will lie in the future we have to understand where the needs are. And so multifamily, you're right, people are crowding in, but you have to find niche opportunities, whether it's in markets that some institutional capital may not go to. For instance, many folks were not going pre the pandemic. Most institutional money was just in the gateway cities because they were like, it's resilient, it's never going to go wrong. And hello, I'm here to tell you that is all off the table. The middle market places in the United States, like the Austins and the Charlottes and the Atlantas, actually performed better. And the reason why I love that is because basis, actually, I'll just do a little commercial for me, as I've always been in the middle market, because I believed in the resiliency of, not just the gateway cities. I'm from New York, and I believe in New York City, and I will always be, a fan and a supporter of New York. But I also think, because I've lived outside of New York, that there are other places that are affordable, tax base is better, and you can get quality of life. And so as an investor, I have to consider those things and where I'm going. And so multifamily right now, cap rates are ridiculous. It's insane almost in certain places. So you have to navigate carefully. With interest rates going up, I know that all of my colleagues say, well, cap rates aren't going to go up and inflation is going to happen, but so will rent growth. I actually think that one of two things has to happen. One, investors have to adjust their return expectations. Or two, cap rates have to go up, because it is just math. It's just math. And so at some point, with treasuries being higher and the cost of debt going up, unless you're going to have negative arbitrage, and certain deals on its face do not pencil out. And so I think my advice to folks that are thinking about the future is to trust the math of it, but also try to understand where, because all of your return is predicated on growth rate at a certain level and then some crazy tight cap rate at the back. I'm here to tell you that it's going to look nice on paper, but it's not going to happen that way. And also, people do lose money in real estate, and this is why these times are really important. Or they don't make the return that they projected. And so this is the time when you're not riding the wave of recovery up, which many of us did, including me, in the last decade. We're being really, really selective about your investments matters.
So how about the capital stack? Where in the capital stack do you like to invest in this kind of a market?
So I believe that a diversified play is a risk mitigant in this market, because there will be certain deals in certain markets that I wouldn't touch an equity piece. And just by way of background, Basis invests and lends across the capital stack. So it's a great setup question for us. So we do commercial real estate debt, and this is all collateralized by commercial real estate across the United States in all markets, with a focus in the middle market. And we also so I think of us as an allocator of capital. We also invest in LP equity positions and non-financial GP positions, all direct into the ownership of the real estate. And so for our investors, what we think makes sense is in these times where you can pick your position in the capital stack to maximize your return and minimize the risk, it's a really good way to think about investing. So there will be deals where we don't love the basis, no pun intended with my firm name. We just say, you know what, if I were in the preferred equity or mezz position, I actually feel good at, $200 a foot. But if I'm in the equity position, at 250, I don't like it as much because a lot more has to go right to actually just achieve my minimum return. So when you have those tools in the shed, in the arsenal where you can be nimble, it actually helps you in markets like these because you can capitalize on risk, and then also brings you opportunity, because in one case you may back someone and say, hey, I'm going to go in here in a debt position, but then the next couple of deals I'll back you as an LP. We don't do debt and equity ever in one deal, but it does bring business to Basis and differentiates us because there aren't that many platforms that do both of those things at the check sizes that we write.
I'm going to hand it over to Scott and Cameron in a second, but it'd be fascinating to hear the story of why you founded Basis. You had a lot of great positions at other places, you're on boards, et cetera. Why? What's the entrepreneurial story behind why you did this?
So I love that question. So I think that when you're an entrepreneur, you kind of feel it in your belly. I like to say that. And my father was a jazz musician, and he played with Duke Ellington and Count Basie. And what I love about musicians, and particularly jazz, is that it's all about improv and the way you think. And so my family is very musical. I sang, I danced, played the flute. And so I knew I didn't want music, but there's a connection between math and music, people say. And so that connection was there for me. I was a very strong math student. And I think about entrepreneurship as improv. Like I think about my dad, riffing with his band and like having to do things and be nimble. And so that is what when I give you a visual of entrepreneurship, at least for Tammy, that is what I feel, that is what I see. And so it was in my belly. I think it was just in my DNA. Because it's not for the faint of heart, because you're going to get a lot of no's. You're going to have to be able to get back up when you don't feel like things are good, and you're going to have to improv, right? And some people aren't comfortable with that. The second thing was that I reported to CEOs and I was in the C-suite, but I never saw anyone who looked like me as a CEO of a major company, a Black woman in real estate. And so I knew that I had to create that role for myself. And so I did.
And how has it gone?
You know what? I am so grateful for all of the opportunity and the doors that have opened. And I would not look back on that decision, even though it was scary, even though it caused me, the famous phrase I always say is get comfortable being uncomfortable, because opportunity does lie at the edge of your discomfort. I live that. And I love building things. I love building businesses. I love creating, bringing teams together. I love creating culture. And so I think I was kind of destined to do this. I'm not going to say I'm the best CEO, but I do think that there are certain leadership elements that I think I possessed, and actually working in the institutions at places like, subsidiary of GM, also the Equitable, also the Case Depot, helped me to get that institutional training. And so there are different paths to get to your journey. Some people think they should just go out and hang a shingle. That wasn't me. I'm risk averse in some respects, although it doesn't sound like it, where I need to know that I know or what I'm doing, or I know what I don't know. And so I can fill that in. And so that institutional training was great because I was able to build a team. I went from running a group to running a department to running, a division, and had 80 people reporting to me and had to set it all up. And so when I went out on my own, I had the institutional infrastructure and technology and know-how to do this. It was still hard, but I didn't walk out into the street and say, now what, right? I was able to know how to put the things in place. And so I'm grateful for my bosses and my mentors, and my CEO at my last firm, who's one of my mentors to this day, thought I was absolutely nuts going out in the middle of the great financial crisis. I saw it as opportunity. That lens, how someone has one lens and they see something and somebody has another lens. Well, that really happened. And, I spoke to him recently, and he's so proud of me, because he said, I knew if you could do this. And he said, and I was scared for you. And sometimes you have to listen to those voices and know that they mean well, but you have to do what's inside.
And in terms of the metrics, you've 4 billion of investments.
Yep.
Tell us more about what the company looks like today.
Yeah. So,
right. And then I am going to hand it over to others.
Yeah, no, these are great questions. So more than 5 billion now. So that's probably needs to update that on some website. And the company has grown from one strategy to this diversified platform. And it really is an investment manager, an allocator of capital. And my vision was to build an investment, the only African-American and female-owned diversified commercial real estate manager and lender in the country. And we've done it. We started with one strategy, which is like, when you think about it, that many years ago, you have one little strategy. So all of our eggs were in one basket, which was doing senior debt. And then we moved into mezz, and then we moved into pref, and then we moved into bridge, and then we launched an equity platform. And then we raised capital with, now we have over 20 public pension plan and sovereign investors that we're investing capital on behalf of. And we had to do that by building a track record. And that's what I would say to folks who have an interest in doing this is it's all about your track record. So it's your track record when you're in an institution, and making sure that it's excellent and that you learn from, if you make mistakes, you learn from them, but also building the track record at Basis got us to the place where, we're diversified, and the vision isn't fulfilled because there's always more diversification and other strategies. But I feel like, from where we started to where we are today, I'm really proud and just grateful to the team.
How big is the team at this point? And do you need more people?
Yeah, we do need more people. And we actually have hired NYU folks. So just so you know that. And right now we're at like 45 people and growing. We have folks all over the country. Most of the folks are in New York, but we do have some folks on the West Coast and in Chicago, in the South, in Atlanta, some places like that. So, and we're hybrid. And I believe very much in flexibility, and that, I don't want geographic barriers for excellent talent.
All right, I've hugged the mic long enough. Scott?
That was fun. Thank you.
Great. Tammy, I love your background. It's very inspiring. Thank you.
Thanks so much.
I also liked your comments about improvisation. Can you take us back a little bit to the first half of 2020? I feel like a lot of people were, obviously we were in a heavy fog on what to do and what was going on. And a lot of people were thinking that residential would be deeply harmed by COVID, given what the employment landscape was looking like. I think your comments about looking more granularly in residential is very insightful. And I'm sure your industry experience allowed you to kind of see it a little bit differently too. But can you walk us through what your thinking was like then and how you were?
Yeah, so it's funny. At that time, I'll never forget. I was about to sign a lease for a 15,000 square foot space. Literally the week before I decided that I was going to pull the team because I was just worried. And I had actually traveled abroad, went on a ski trip in Europe, which is the weirdest thing. Personal footnote, I'm an avid skier. My husband and I ski all over the world. And I heard about, we heard about the virus, in Asia. But then in Europe, it was also there. And so I started to get a little wigged out. And it's, again, global thinking, reading different newspapers, right, than you're reading in the States. And so I said, something's not right here. And so I was nervous. So I didn't sign that lease. And I remember thinking, well, let me get my team and the folks out of the office now, before anyone was thinking about doing it. This was probably late February, early March, if I'm not mistaken. And so we started having test drills because Basis was unfortunately affected by Hurricane Sandy, and we were out of our office for 8 weeks at one point because we were down on Wall Street, and some of those firms, the basements were flooded. You guys might remember that. So we kind of had this sort of disaster recovery experience. So I said, you know what? Let's start testing. Let's start working from home. Let's start doing this. And then I got that feeling. Again, I always tell people, when you have that feeling and that instinct, believe it, like literally. And that's how it's sort of my barometer. And so I didn't sign the lease, started doing the tests. And I don't know that I can say that I knew that this was going to be as long as it was, but I felt in my spirit that it wasn't going to be as short as what people were saying, right? So I don't, again, and I think my instinct was to triage. And I think you've heard that word. And so the first thing we did was we looked at our portfolio to say, okay, what are our most vulnerable investments? And we contacted every single one of our partners and borrowers, and we just began that process. And at this point now, we're probably around March 20th, towards the end of March, and it's starting to get, more scary, and you're starting to see like NBA games not happening, and you're starting to know that this is a thing, right? And so triage was the first step, and then also communication. So understanding what you have, assess your problem, communicate with your investors, tell them, and you know what? I said, I don't know what's going on, but I want to reach out to you because I want you to know that this is what we're doing, right? And so it was so helpful because what it does is it engenders this trust where we're all nervous, but it wasn't like Basis was dodging calls. We called you and we said, here's what we're doing. We're going through our investments. Thankfully, the highest percentage of any property type was multifamily. Again, in those little granular categories that we talked about. We had some student housing. I should have added that. Student housing performed outstanding, which everyone was like, oh, it's terrible. Ours did not, depending on which universities, depending on where kids wanted to, students wanted to live. So went through the portfolio, communicated with investors. And then the final step is, assess, communicate, and try to offer assistance if you can, right? Where do you need help? And how can I use my capital to help my partners? And we did. We came up with this thing called the Big Rescue, which was rescue gap equity to say, hey, we have a lot of money and you don't, particular partners, particularly our hotel partners. And we said, we're going to structure something where we'll give you some gap equity and we'll help you so that way you don't have to worry about paying debt service to your senior loan or if we're in a mezz, and you can worry about operations. And it went a long way. And I'm here to tell you, all but one of those gap equity investments has paid us back. Right. And that one is going to pay us back too. And so I learned from that. I learned to say, step back. And it's like, and I give this advice, not as if to say I know everything again, but just to say that approaching the problem, not being afraid of it, always communicate, structure, see how you can assist to mitigate risk. Because that rescue equity also mitigated risk for Basis because we were able to make sure that our investments were still performing. And our investors really they gave us a lot of kudos and praise for quick thinking and for being creative.
Yep, that's great. And clearly it's helped you get through, we'll call it the COVID downturn. Now we come out of it. But so where are you looking now? Are there metro areas that you're focusing on? Are you focusing a little bit differently on property types? And where do you think your future growth is going to come from?
Yeah, so we're looking at a number of the same metros, because again, we were in the middle market. A lot of people are coming to the middle market, and I'm not that concerned because the middle market is about relationships. There's a lot of regional owners and operators, and you can't just hang a shingle and meet all those people. So I'm not that worried about that competition. But what Basis does, which again is a little bit of our playbook, is because we're this allocator of capital, we're not just a debt platform, or we're not just an equity platform. We don't just wait for deals to fall out of the sky from brokers. We actually, on a quarterly basis, we select our top 25 markets. And we do this with an extensive analysis of, employment growth, population growth, demand generators, tech, looking for where people migration. So we have this huge model, and we will look at, and quarterly it doesn't really change, but we at least sit down together and figure out what our markets are. And then we actually send teams to the market. In COVID, we had to like find people, do Zoom calls just like this. And we also raised a lot of capital, LP capital during Zoom. But we go to the markets with a debt and equity representative, and we meet everybody. We meet developers, we meet leasing brokers, we meet property managers, just whoever's in the market that we can help. We obviously, you probably read that we have a strong outreach to diverse owners and operators of commercial real estate across the country. And so, we make sure that we have outreach to all people of color as well as women, because we want to make sure that our capital is going to those who need it as well, who also are strong performers. And our portfolio of $1 billion with, diverse owned real estate owners has outperformed our other portfolio. And I'm really excited to report that. So those markets would include markets like I mentioned Charlotte. We're looking at Boise, Idaho. We're looking in Utah with the Silicon Slopes, Salt Lake City. We're looking in Baltimore. I'm not going to tell you all of our secrets, but I will say that, strong market growth where there are demand generators. And you can look at migration. I mean, I follow migration being African-American, thinking about the Great Migration. And so it kind of informs how I think about where things are going, where people are moving. You think about the gateway cities, and what's happening is, even though there's recovery, they're so expensive to live in. And folks are, having to have 16 roommates. I have kids that are going through this now, who are just, in order to be able to afford someplace, they have to do, double up and triple up and all that kind of stuff. And so I do think that some of these other cities are taking advantage of those dynamics to be able to have quality of life. And then you also see the same thing happening with large companies. And we haven't talked at all about office and just kind of what's happening with that. But a lot of the large companies, even tech companies, are finding satellite places to go and hang a shingle because cost of occupancy is lower. As far as new opportunities are concerned, I mean, we're looking at all the areas of multifamily that we talked about. I believe in I'm looking at cold storage, believe it or not, with online grocer and the disintermediation and transformation of that market. We did something that I think our investors gave us credit for in the GFC when retail was going, haywire, and everyone was like, don't do retail. Because again, I always challenge people when they have these large umbrellas of retail. I'm like, is it all retail? Is it just retail's bad? And I said, all retail is not bad. In fact, drug and grocery anchored centers are on fire, and they did well because guess what? In COVID, you needed food and shelter, right? And so everyone was going to the community centers, and our drug and grocery anchored portfolios did so well. Collections went down maybe to like 85%, but now they're back up to 95, and they never ever went below anything where we were concerned. And so I think about new opportunities. Drug and grocery anchored retail was resilient. I think hotels are coming back, and I think as we dig out of this pandemic, and again, it's not over yet. I mean, look, every time I turn around, someone else has COVID. In fact, I just took a COVID test for exposure, the other day again, and so this continues to happen. But I do think that people are feeling more confident about travel. So limited service hotels. We definitely are looking at some life science, although that's kind of cuspy and scary depending on the tenancy, right? You have to just know how to underwrite the tenants. And let's see what else. Office, we're cautious about, and I'll just be honest. I believe that office is not dead, but I do believe that just like we were over-mauled in the United States compared to other countries, I think that we have too much office, and I think that our stock of office needs to change. And what the pandemic brought us, and with the younger, millennial folks who are demanding health and wellness in their buildings, great amenities, outdoor space, it's actually pushing to the forefront those wellness buildings and LEED certified buildings that actually are consistent with your culture and who you are. And so those folks will be winners. And so we're looking at office. But let's just face it, even if 25% of our office stock goes away because we're all reducing our footprint, go back to the story about how I didn't sign that 15,000 square foot lease. Well, today I'm looking at something that's probably more like 12, smaller. But if everyone does that, there's impact there. There's real impact. And so, hopefully there'll be, and we're looking at adaptive reuse for some opportunities, backing folks who are taking office and maybe making loft apartments. The other thing that we know is that there is an affordability crisis in America in housing. So we're trying to figure out what are the conversion opportunities, what are the zoning opportunities that we can back someone who is changing a use. And I think you can get creative. You can get creative with that. We look at self-storage because of space issues. Self-storage is actually something that used to be a lot more difficult, but depending on the operator, because it's an operating business, we think self-storage is interesting. So again, we look across all property types, and we look across positions, and that's how we believe we're going to be able to mitigate risk and maximize return.
Gotcha. Yep. Look, you covered a lot of ground there. I agree with a lot of it, and some of it's really insightful. I'd love to dig in more about your thoughts on possible distress in the marketplace, but in the interest of time, maybe we should instead go back a little bit and talk about DEI. This is a really interesting and dynamic period. Basis is well positioned to really make a strong statement in DEI, and I think you've done so with Genesis Bank partnership. Can you talk to us a little bit more about that?
Sure. So I'll start with tell you about Genesis Bank first, and then I'll kind of go back into the culture. And so Genesis Bank is a MDI, Minority Depository Institution, and they have a bank charter, just to keep it simple, and they focus on providing capital in underserved communities in and around Orange County, and that's obviously on the West Coast. So why they are a good partner for us is because Basis has a mission to provide capital to all borrowers and investors in all communities. And so one of the ideas that I came up with, again, thinking creatively, trying to figure out how do you find partners, is to figure out where there's alignment with folks that are handling particular areas in the country. And so Basis is the only African-American and female-owned seller servicer with Freddie Mac right now, who is a liquidity provider for mortgage debt for multifamily. And so we approached Genesis Bank about providing them access to not only our Freddie Mac strategy, but all the strategies that I just talked about, the mezz, the pref, the bridge, the equity, to their hosts of borrowers. So that way we could figure out how to invest and lend with them in certain communities that they cover. And so we're excited about it. I don't know if it's going to work. I pray that it will, but both of us believe, I'm a big proof and concept type person, where I think that you try to figure out if there are areas that make sense and that overlap and synergies. And then if you find that there are challenges, you try to figure out how to overcome those challenges. So I'm excited about that. And Basis has DE&I in our DNA. I mean, we, as an African-American and female-owned diversified firm, my vision was to build something that was different. I told you about creating the position for myself, but I also wanted to create an environment that was inclusive. And so to that end, 75% of our team is women and minorities, and over 80% of our senior leadership team, which is kind of where when you ask those questions, you have to actually really dig, are also diverse. And it's because we just have an inclusive approach to everything. 50% of our vendors, folks who we do business with, who we hire, are diverse. And we've invested and loaned $1 billion with other folks who look like me across the United States. And so I feel like it's our secret sauce. It has led to outperformance. I think diversity does lead to outperformance, because you have the benefit of so many different thoughts and views and lenses. And that just makes a strong team. If you think about it, when you're learning in your master's programs about, portfolio diversification and how not having all your eggs in one basket. And so it is great when you have a team that thinks differently, that knows different markets, that's not afraid to go into, Newark, or whatever the community is, if that's something that you want to do. And so I just can't, stress enough that it's important that there is a diversity business plan, just like any other strategy. It's not something that you just run off the side of your desk. Can you imagine if I said, oh, I'm going to do a multifamily strategy and I'm not going to have any performance metrics. I'm not going to really, have anyone accountable for it. And I'm just going to, hope for the best. And that's what we've done as an industry. From the moment I joined commercial real estate, there were fits and starts of efforts, but there were no accountabilities and no performance metrics, and it didn't affect anyone's compensation. And so unlike a strategy, the multifamily strategy that I just described, what results would you expect? And so when I met with CEOs across the country, including some REIT CEOs, I said, what business do you run like that? Absolutely none. And if it's really, really endemic and important to you, then it just becomes, you have to have a plan. Things that are not measured do not change. And I hate when people say quotas. That's the one thing, if you say that, you'll see me go, a little red. It's not about quotas. It's about aspirational targets, just like we do anything else. And so I really believe that it makes you better. And with ESG, environmental, social, and governance, I'm so hopeful that the investor community cares about stakeholders, and that includes DE&I is part of the S in ESG. And I happen to chair the NESG committee for Crown Castle, the digital infrastructure cell tower company. And I'm very excited about, the fact that, we are showing, our investors that, the nominating and governance committee is also including ESG. So hopefully things will change as we go forward.
Yeah, no, that's spot on. And I love your analogy of comparing it to investment strategies. You wouldn't just dabble in it or just have a criteria goal. Obviously, commercial real estate's been a little bit slow to evolve. And how do you think it's going from a DEI perspective?
I think that investors are going to have to, unfortunately, there has to be more of a carrot. Stick, not a carrot. And I do believe that that companies are, I've seen some progress, but I am cautiously optimistic. And I think that George Floyd and some of those horrible murders really shocked our country. And I feel like there's a cooling off a little bit of that. And I think that there's some pushback on, some things that I'm dismayed about, but I'm continuing to shine a light on it. And I think that everyone who cares about it should continue to push. And I'm hopeful that ESG and just the movement that Europe is way ahead of us on, and students, please focus on environmental and social governance and really understand what that means to put on your ESG glasses and look at investing through that lens. I believe investors are going to continue to push for it and require it. And S is a really big part. And so I think that will be the stick, because if your investors are asking you for, what is your ESG strategy? How is it integrated into your investment performance? What are you doing, to care about the planet? And the commercial real estate industry, we are big offenders in terms of our carbon footprint. We can't ignore it. And so is it going better? Yeah, but I still think that I've seen this movie before where there's been a surge and then it just kind of peters out. So we have to keep people accountable.
Good. Appreciate that. So look, now I'm hogging the mic a little bit. One of the great things about my role is I get to engage with people who I think are going to be, the industry's future leaders. They see the world differently than I do. They're coming at it with different experiences. And so Rob and I wanted to bring students into these conversations so they can bring their insight and pose questions to you. Love to introduce you to Cameron Spiller, one of our current graduates. He has a few questions for you. Cameron?
Hey, thank you so much for that introduction, Robinson. And thank you, Tammy, for taking the time to, share a bit of your knowledge and experience with us. I really appreciate your time today. You have a firm that invests across the capital stack by diversifying the firm's investments in both debt and equity. What's even more impressive and telling of your character is that you started your firm in the middle of the global financial crisis, which I think is very, impressive. and quite brilliant. You're brilliant at finding opportunities in moments of adversity and challenge. And speaking about, certain of the challenges that we face right now in affordable housing, how do you see, your company's role and throughout this affordable housing crisis? And what opportunities are you finding?
Great. Well, first of all, nice to meet you, Cameron, and really great question. So I grew up in affordable housing. I say that all the time. I grew up in a 2-bedroom apartment with 8 people. And so I know best what it means to live in conditions where, some people may not understand, but also that it's a great community, because there are great communities in these affordable projects. And so, and with pride about, your little plot of front lawn or not, or your bench or whatever it is. And so for me, I am committed to getting capital to affordable developers. I also am a big supporter of workforce housing. I think that both are needed. And I think that the model of just only having affordable housing is something that hasn't succeeded necessarily. If you look at our affordable housing stock across the nation, it's old. It's in infrastructure. To me, it's literally deteriorating and dilapidated infrastructure. And so that's one opportunity, is to look at it that way and to figure out where we need to not just add affordable housing, but possibly start over or really, really renovate, right? The second place that the basis focuses is on workforce housing too, which and in certain places, workforce housing is affordable housing, because it literally is also the bread and butter. And so I do think that we need to recognize that we have, as I've said earlier, an affordability crisis in American housing, and try to figure out how to get capital to some, again, diverse developers who are going into these communities. That's one way where we're making sure that, diverse owners and operators will invest together, and they invest back in their communities. And there's a multiplier effect in the community because we're creating jobs. And so that's how Basis, has backed folks, debt and equity, in both affordable and workforce housing. And we use our agency license to help in that regard as well.
It seems like you've taken your lens and really been able to understand and see the opportunities that lie in some of these communities. Could you speak a little bit more about the demand factors and some of the risk, or demand generators and some of the risk factors that you find in affordable housing nowadays?
So I think I love that question, because I think that in affordable housing communities and areas, you have to be careful about, I'll say the ugly word, gentrification. And if you have no gentrification, it's just my humble opinion as a woman who lived in affordable housing, you will have deterioration, right? And so there has to be a balance between getting folks that want to come into these communities, a combination of market rate and affordable, because you want to actually create community and create place. We talk about in real estate how important it is to create place. When I grew up, there were check cashing places, liquor stores, fast food on every corner, and there wasn't a grocery store, right? And so think about how incredibly difficult that is, and think about what that leads to. And so when we look at working with developers who are creating place, who are trying to attract the grocer and that, the Whole Foods, the places that are healthy to eat, that are trying to, figure out ways that we can get national tenants to come in, and national amenities to come in. So I believe that there is a balance, and it's hard. It's not easy. The other thing I was going to say, my husband is a developer. He's actually a developer in Boston, and he's working on a really large project. And I'm not going to say what it is because I'm not sure if I can, but one of the concepts that he has that I've been working with him on with affordable housing is also, we need a combination of affordable housing and also wealth creation to buy housing. And so the solution has always been create more affordable, and then you're creating serial renters. My parents rented an apartment for 40 years. And if I could say to my parents and go back with the knowledge that I have today, it would be I bought my first house at 25. And then I was able to buy the next one and the next one. So affordability, I just want people to, think about the model differently. it's not just rental. It's also, how do you get down payments in the communities? Because access to capital is the biggest challenge that we face. I didn't have an uncle or a grandma or someone who gave me any money. I went to college on a scholarship, and I'm the first woman in my family to go to college. So I understand these needs. And it's not about, just not doing affordable rental, but it's about, I talk about this diversified approach. It's about doing both. And I don't see too many people doing both in a community. And so one of the things that my husband's development is going to do is do both. And I think that's a winning model.
Yeah, you're so capable of being able to tie all of your life's experiences to real estate and what you're doing now. And, I really believe that you are destined to be, I'm gonna give you your crown now because I believe that the work comes before the title, right? But you are definitely working your way to be the absolute best CEO. Just to, touch back on the communities that we come from, that you come from as well, how can we start to expose, Black and brown individuals, youth, and young adults that are coming out of high school or going into college to commercial real estate or real estate in general?
So I founded a program with Real Estate Executive Council, which is the preeminent professional trade organization for African American Latinx executives in real estate. It's called Real Estate Exchange. NYU is participating, and my foundation, which was my dream to have a company, but also to have a way to give back, called Basis Impact Group, is one of the founding sponsors of this program. And we have now exposed, I guess it's like 650 high school students to commercial real estate. NYU is one of our schools, and we're doing the program with NYU, I think, in Cornell, only because we're just going back on campus this year. And it was virtual for the last 2 years, as you guys would imagine. But it's a commercial real estate and multifamily immersion to folks. 50% of the kids are from, economically disadvantaged backgrounds like me. And I'm going to be opening, I think I'm going to Harvard and MIT to talk to these kids. And I love it. Like, of all the things that I do, I love speaking to folks and encouraging them and saying, I want you to leave this program and not think about how do you work at this building. I want you to think about how do you own that building. And if I can do it, you can do it. And so it really is, it's amazing, the energy and we have a Shark Tank competition. And these kids are actually thinking about health and wellness, DE&I, environment. And I feel like we can take a page out of their book because we'll give them a project and they'll come back with all these different uses. And so I actually am encouraged. Your question earlier, Scott, about am I encouraged? I don't know that I'm encouraged about this generation, but I'm really encouraged about the next one.
Absolutely. And finally, where do you see BIG, moving forward? Where do you see your firm going? Yeah,
I think we're going to continue to increase our AUM and hopefully our investor base and continue in some of the strategies that we're in, the debt and equity. But I have a real interest in prop tech, so I'll check back with you on that.
It's excellent. Thank you so much for your time again. This has been great.
Robin, you want to take us out?
Yeah, no, we could keep going. This has been just a fascinating tour. Can't thank you enough. We'd love to have you back and have you at the REIT conference as well with all the boards you sit on.
Oh, absolutely.
We'll be in touch, but really that was fabulous. Thank you so much.
Thank you so much. Enjoy the rest of your day. Bye-bye.
Take care.